Are you tired of watching the rich get richer while your money sits in a savings account earning nothing? What if small, unknown companies could make you wealthy beyond imagination? Most investors chase big-name stocks and miss incredible opportunities. While everyone buys Apple and Tesla, smart money quietly builds fortunes in microcap stocks. These tiny companies can explode by 500%, 1,000%, even 5,000%. Justin Waite cracked the code. He turned small investments into millions through microcap stocks. This is not gambling. This is strategic investing in overlooked companies before the world discovers them. In this video, you will learn his exact system: how to find hidden gems, how to avoid scams, how to build serious wealth from small cap investing. Stay focused, because one strategy in this book could change your financial future forever. Let's unlock the secrets of Microcap Millionaires. Chapter 1. Understanding Microcap Stocks. Microcap stocks are companies with market capitalization between $50 million and $300 million. These are small, often unknown businesses that big investors ignore. Wall Street focuses on large corporations. Institutional investors cannot buy microcaps because positions are too small. This creates opportunity. You can invest in companies before they become mainstream. Justin Waite explains that microcaps offer asymmetric returns. You risk $1 to potentially make $10, $20, or $50. This risk-reward ratio does not exist in large-cap stocks. Apple doubling is unlikely. A $50 million company doubling happens regularly. But understand the risks clearly. Microcaps are volatile. Prices swing wildly. Many companies fail completely. 90% of microcaps will disappoint. Your job is finding the 10% that succeed spectacularly. Liquidity is limited. You cannot easily buy or sell large positions. This illiquidity creates pricing inefficiencies. Smart investors exploit these inefficiencies. Patience is essential. Quick flips rarely work in microcaps. These stocks do not appear on mainstream news. CNBC does not cover them. Financial advisors do not recommend them. This obscurity is your advantage. Information asymmetry creates profit opportunities. Microcaps operate in every industry: technology, healthcare, energy, consumer goods, mining. Diversification across sectors reduces risk. Do not concentrate everything in one industry. Spread investments intelligently. The microcap market is inefficient. Large markets are fairly priced because millions analyze them. Microcaps have few analysts. Fewer eyes mean more mistakes in pricing. Mispricing creates opportunity for diligent investors. Many microcaps are undervalued temporarily. A bad quarter drops the stock dramatically. Patient investors buy quality companies at discount prices. When performance improves, prices recover. This value investing approach works consistently. Some microcaps grow into mid-caps and large caps. Early investors make fortunes. Amazon was once a microcap. Netflix was a microcap. Starbucks was a microcap. Finding the next giant requires research and conviction. Waite emphasizes that microcap investing is not for everyone. You need high risk tolerance. You must handle volatility emotionally. Weak hands sell at bottoms. Strong hands hold through storms and capture gains. Study market history. Microcaps outperform large caps over long periods. Academic research confirms this. The small cap premium is real. Smaller companies grow faster percentage-wise than large companies. Understand business cycles. Economic downturns hit microcaps hardest. They have less financial cushion.
But recoveries also benefit them more. Timing matters. Buying during fear maximizes returns. Build knowledge systematically. Start with one sector. Become expert in that area. Deep knowledge reveals opportunities others miss. Specialization beats generalization in microcap investing. Develop an investing philosophy. Are you a value investor, growth investor, turnaround specialist? Clear philosophy guides decisions. It prevents emotional mistakes. Consistency improves results over time. Set realistic expectations. Microcap millionaires are made over years, not months. Patience is critical. Compounding requires time. Quick riches rarely materialize. Sustainable wealth builds gradually. Accept that mistakes are inevitable. Even the best investors pick losers. Position sizing protects you. Never risk more than you can afford to lose. Capital preservation enables you to play long-term. Microcap investing is contrarian. When everyone is fearful, you buy. When everyone is greedy, you sell. Following crowds loses money. Independent thinking wins. Develop courage to act differently. This asset class rewards homework. The more you research, the better you perform. Lazy investors lose money. Diligent investors find winners. Work ethic directly correlates with returns. Prepare for the journey. Microcap investing is challenging but rewarding. The potential is enormous. The risks are real. Your education starts now. Master the fundamentals before investing a single dollar. Chapter 2. The Microcap Millionaire Mindset. Success in microcap investing starts with the right mindset. Psychology determines results more than intelligence. Smart people with poor psychology lose money. Average people with strong psychology build wealth. Justin Waite teaches that patience is the ultimate competitive advantage. Microcap investments need time to mature. Businesses take years to execute plans. Impatient investors sell too early and miss massive gains. Develop emotional discipline. Prices will fluctuate violently. Your portfolio will drop 30, 40, 50% sometimes. Panic selling locks in losses. Calm holding through volatility captures eventual gains. Understand that Mr. Market is bipolar. Benjamin Graham's concept applies perfectly to microcaps. Some days the market offers ridiculously low prices. Other days it offers absurdly high prices. Rational investors exploit this irrationality. Embrace uncertainty. You will never have complete information. Perfection is impossible. Waiting for certainty means missing opportunities. Act on sufficient information, not perfect information. Think independently. Analyst reports are rare in microcaps. You must form your own opinions. Challenge assumptions. Question narratives. Original thinking finds hidden opportunities. Learn from mistakes quickly. Every losing investment teaches lessons. Analyze what went wrong. Was it poor research? Bad timing? Thesis error? Extract lessons. Apply them to future decisions. Avoid overconfidence. Early success creates dangerous arrogance. Markets humble everyone eventually. Stay humble. Respect risk constantly. Overconfidence destroys accounts faster than ignorance. Develop a long-term perspective. Quarterly results do not matter much. Focus on 3 to 5 year potential. Short-term noise distracts from long-term value creation. Train yourself to ignore daily fluctuations. Accept losses gracefully. Not every investment works. Cut losses when thesis breaks. Holding losers hoping for recovery rarely works. Admit mistakes. Move capital to better opportunities. Waite emphasizes continuous learning. Markets evolve. Industries change. Successful investors adapt. Read constantly. Study companies. Analyze financial statements. Learning never stops. Build conviction through research. Deep research creates confidence. Confidence allows you to hold through volatility. Superficial knowledge leads to panic selling. Do the work, earn your conviction. Separate signal from noise. Information overload paralyzes investors. Most news is irrelevant. Focus on fundamentals. Ignore stock price chatter. Quality information drives good decisions. Cultivate patience for compounding. Wealth builds exponentially, not linearly. Early years feel slow. Later years accelerate dramatically. Trust the process. Stay invested. Let compounding work. Control fear and greed. Fear makes you sell at bottoms.
Buy at tops. Both destroy returns. Rational decision-making requires emotional control. Develop systems that remove emotion. Embrace being wrong. Even the best investors are wrong 40% of the time. What matters is risk management and position sizing. Being right more than wrong and managing risk creates wealth. Think probabilistically. No investment is certain. Assign probabilities to outcomes. This thinking improves decision quality. It also prevents devastation from unexpected results. Maintain realistic expectations. Microcap investing offers high returns, but requires accepting high risk. Some years you lose money. Other years you make multiples. Average returns over decades matter most. Stay humble before markets. Markets are bigger than any individual. Arrogance gets punished. Respect market forces. Adapt when you are wrong. Survival beats ego. Develop mental toughness. This journey tests you psychologically. Portfolio drops feel painful. Missed opportunities sting. Develop resilience. Champions bounce back from setbacks. Remember that mindset is trainable. You can develop discipline, patience, and emotional control. Practice these qualities deliberately. They compound like money. Strong psychology is your ultimate edge. Chapter 3. Finding Hidden Gem Microcaps. Finding great microcap investments requires systematic research. Random stock picking loses money. Structured processes find winners consistently. Justin Waite recommends starting with stock screeners. Filter for market cap between $50 and $300 million. Add criteria like positive earnings growth, low debt, and revenue growth. Screeners narrow thousands of stocks to manageable lists. Read financial statements thoroughly. The 10K annual report contains everything. Study the business description. Understand revenue sources. Analyze expense structures. Financial statements reveal company quality. Look for strong balance sheets. Companies with cash and minimal debt survive downturns. Debt-heavy companies often fail during tough times. Balance sheet strength provides safety margin. Examine revenue trends. Consistent revenue growth indicates healthy business. Erratic revenues signal problems. Multi-year trends matter more than single quarters. Study 5 to 10 years of data. Analyze profit margins. Expanding margins show improving efficiency. Shrinking margins indicate competitive pressure. Compare margins to industry averages. Superior margins suggest competitive advantages. Check cash flow statements. Earnings can be manipulated. Cash flow is honest. Companies generating strong free cash flow create real value. Negative cash flow companies often dilute shareholders. Research management teams. Read bios. Study track records.
Have they built successful companies before? Do they own significant stock? Skin in the game aligns interests. Great management overcomes obstacles. Understand the business model. How does the company make money? Is it simple or complex? Simple businesses are easier to analyze. Complex businesses hide problems. Clarity is valuable. Identify competitive advantages. What protects this business from competition? Brand, patents, network effects, cost advantages? Companies without moats struggle long-term. Durable advantages create lasting value. Study industry dynamics. Is the industry growing or shrinking? Who are the competitors? What are the barriers to entry? Industry tailwinds help weak companies. Industry headwinds hurt strong companies. Emphasize looking for catalysts. What will drive the stock higher? New product launches, contracts signed, regulatory approvals, acquisitions? Catalysts accelerate returns. Businesses without catalysts stagnate. Attend industry conferences. Microcap management teams present at small conferences. You can meet CEOs personally, ask questions directly. This access is impossible with large caps. Use it. Join investment forums. Microcap investors share research online. VIC and similar platforms provide ideas. Verify everything yourself, but forums surface companies you might miss. Follow insider buying. When CEOs buy stock with their own money, pay attention. Insiders know more than outsiders. Significant insider buying often precedes price appreciation. Look for spin-offs. When large companies spin off divisions, the new entities become microcaps. Spin-offs often outperform because they are ignored initially. Research spin-offs systematically. Investigate bankruptcy recoveries. Companies emerging from bankruptcy often trade cheap. If the business model is fixed, returns can be spectacular. This requires specialized knowledge. Study bankruptcy investing thoroughly first. Monitor promotional campaigns. Some microcaps hire promoters to pump stocks. Avoid these. Promotion indicates weak fundamentals. Real companies do not need hype. Quality attracts investors naturally. Check short interest. High short interest sometimes indicates problems, but sometimes shorts are wrong. When heavily shorted stocks improve, short squeezes create explosive gains. Analyze case by case. Network with other investors. Build relationships with people who share your interests. Discussion improves thinking. Others spot things you miss. Quality networks provide valuable intelligence. Finding great microcaps requires effort. There are no shortcuts. Develop systematic processes. Follow them consistently. Over time, you develop intuition. Pattern recognition improves. Winners become easier to identify. Chapter 4. Analyzing microcap financial statements. Financial statement analysis separates winners from losers. Numbers reveal truth. Promotions mislead. Learn to read financial statements expertly. Justin Waite teaches that the balance sheet shows financial health. Assets minus liabilities equals shareholder equity. Strong companies have more assets than liabilities. Weak companies are over-leveraged. Current assets should exceed current liabilities. This means the company can pay short-term obligations. Current ratio above 2 is comfortable. Below 1 indicates liquidity problems, immediate bankruptcy risk. Examine cash positions. Cash provides flexibility. Companies with substantial cash can invest in growth or weather storms. Minimal cash means vulnerability. One bad quarter could be fatal. Study inventory levels. Rising inventory relative to sales suggests slowing demand. Products are not selling. This is a red flag. Declining inventory with rising sales indicates strong demand. Analyze accounts receivable. Receivables growing faster than revenue means customers are paying slowly. This ties up cash, and it might indicate quality problems with products or services. Long-term debt requires scrutiny. Divide total debt by equity. Debt to equity above 1 is concerning. Above 2 is dangerous. Low debt provides safety. Companies without debt cannot go bankrupt. The income statement shows profitability. Revenue is the top line. Net income is the bottom line. Everything in between matters tremendously. Revenue growth is essential. Without growth, companies stagnate. Look for consistent growth over multiple years. One-time spikes mean nothing. Sustainable growth creates value. Gross profit margin reveals pricing power. Gross profit divided by revenue. High gross profit indicates strong products. Low gross profit mean commodity businesses. Target companies with 40% plus gross margins. Operating expenses must be controlled. Sales and marketing, research and development, and general and administrative costs. Expenses growing faster than revenue destroy profitability. Disciplined cost management is crucial.
Operating income shows core business profitability. This is profit before interest and taxes. Positive operating income is fundamental. Negative operating income means the business model is broken. Net income is the ultimate measure. After all expenses, what remains for shareholders? Consistent profitability over years indicates quality. Erratic profitability suggests problems. The cash flow statement is most important. Waite emphasizes this repeatedly. Earnings are opinions. Cash flow is fact. Companies cannot fake cash. Operating cash flow shows cash generated from business operations. This should be consistently positive. Negative operating cash flow means the business burns cash. That is unsustainable without financing. Capital expenditures indicate investment in growth. CapEx should support revenue growth. Excessive CapEx relative to growth wastes money. Insufficient CapEx means underinvestment. Balance is key. Free cash flow equals operating cash flow minus capital expenditures. This is cash available to shareholders. Positive free cash flow is excellent. Growing free cash flow is spectacular. This metric is critical. Financing activities show debt and equity transactions. Companies constantly raising money dilute shareholders. This is a red flag. Self-sufficient companies create shareholder value. Compare cash flow to net income. They should be similar over time. Large discrepancies suggest accounting issues. Cash flow consistently below earnings raises questions. Calculate financial ratios. Return on equity shows how efficiently management uses shareholder capital. Above 15% is good. Above 20% is excellent. Return on assets indicates asset efficiency. Companies generating high returns on assets are well managed. Low returns suggest poor asset utilization or low-margin business. Debt service coverage ratio shows ability to pay debt. Operating income divided by debt payments. Above 2 is healthy. Below 1 means the company cannot service debt from operations. Waite recommends building Excel models. Input 5 to 10 years of historical data. Calculate trends. Project future performance. Modeling deepens understanding. It reveals insights superficial reading misses. Learn accounting basics. Understand accrual versus cash accounting. Know how depreciation works. Grasp tax impacts. Accounting knowledge is your competitive advantage. Financial analysis is tedious. Most investors skip it. That is why most investors fail at microcaps. Winners do the work others avoid. Master financial analysis. It separates you from the crowd. Chapter 5. Valuation methods for microcaps. Determining what a company is worth is essential. Overpaying destroys returns. Buying bargains creates wealth. Learn multiple valuation methods. Justin Waite teaches that price-to-earnings ratio is most common. Divide stock price by earnings per share. Compare to industry averages. P/E ratios below industry average suggest undervaluation. Above average suggest overvaluation. But P/E ratio has limitations. Earnings can be manipulated. One-time items distort results. Use P/E ratio carefully. Never rely on it alone. Price-to-sales ratio eliminates earnings manipulation concerns. Divide market cap by annual revenue. This shows how much you pay per dollar of sales. P/S ratios vary by industry. Compare within sectors. Technology companies might have P/S ratios of 5. Retailers might have P/S ratios of half. Context matters. A P/S ratio of 1 is often reasonable for microcaps. Price-to-book value compares market value to book value. Book value is assets minus liabilities. P/B ratio below 1 means trading below liquidation value. This often indicates deep value opportunity. However, book value uses historical cost. For asset-light businesses, book value is less relevant. For asset-heavy businesses like manufacturers or real estate, book value is very relevant. Enterprise value is more accurate than market cap. EV equals market cap plus debt minus cash. This shows the true acquisition cost. Always use EV for comparisons. EV to EBITDA ratio is popular. EBITDA is earnings before interest, taxes, depreciation, and amortization. This shows operating performance. EV to EBITDA between 5 and 10 is often reasonable for microcaps. Discounted cash flow analysis is most theoretically correct. Project future cash flows, discount them to present value, sum them. This is intrinsic value. Compare to current price. DCF requires assumptions about growth rates, margins, and discount rates. Small changes in assumptions dramatically affect value. Use DCF cautiously. It is only as good as your assumptions. Waite recommends sum of the parts valuation for diverse businesses. Value each business segment separately. Add them together. Sometimes the parts are worth more than the whole. For example, a company with a profitable core business and valuable real estate. Value the business using earnings multiples. Value real estate separately. Add together. Compare to market cap. Comparable company analysis uses peer valuations. Find similar companies. Average their valuation multiples. Apply to your target company. This reveals relative value. If competitors trade at 10 times earnings and your target trades at 5 times earnings, it might be undervalued. Assuming similar quality. Quality differences justify valuation differences. Precedent transaction analysis examines acquisition prices. What have similar companies sold for? Apply those multiples to your target. This estimates takeout value. Microcaps with acquisition potential trade at premiums. Acquirers pay control premiums. If your company is attractive to buyers, estimate takeout value. This provides upside potential. Liquidation value is downside protection. What could assets sell for in bankruptcy? Inventory at 50 cents on the dollar, equipment at 30 cents on the dollar, real estate at market value. Sum everything, subtract liabilities. If stock trades below liquidation value, downside is limited. Even if the business fails, assets have value. This provides margin of safety. Benjamin Graham called these net nets. They are rare but valuable. Replacement value estimates cost to build the business from scratch.
Buildings, equipment, inventory, customer relationships. What would it cost to replicate? If market cap is below replacement value, it is potentially cheap. Waite emphasizes using multiple valuation methods. No single method is perfect. Triangulate using several approaches. Convergence of methods increases confidence. Divergence suggests uncertainty. Build sensitivity analyses. Change assumptions. See how valuation changes. This reveals risk. It also shows opportunity. Understanding valuation range is more useful than single-point estimate. Always demand margin of safety. Never pay full intrinsic value. Buy at 20 to 30% discount minimum. This protects against mistakes. It also provides upside. Valuation is art and science. Numbers provide science, judgment provides art. Develop both. Over time, your valuation accuracy improves. Better valuation creates better returns. Chapter 6. Risk Management and Position Sizing. Risk management determines long-term success. Brilliant stock picks mean nothing if one mistake wipes you out. Survival enables compounding. Compounding creates wealth. Justin Waite teaches that position sizing is most important risk management tool. Never put too much capital in one investment. Concentration creates risk. Diversification reduces it. He recommends maximum 5 to 10% per position initially. Even high-conviction ideas should not exceed 15%. One disaster at 25% position size devastates portfolios. Diversify across sectors. Do not put everything in technology or energy. Economic cycles affect industries differently. Sector diversification smooths returns. It reduces volatility. Aim to 10 to 20 positions minimum. Fewer than 10 is risky. More than 30 is unmanageable. Find your balance. Quality and quantity must coexist. Understand that diversification reduces returns slightly. Concentrated portfolios outperform when picks are right. But one mistake in concentrated portfolios is catastrophic. Accept lower returns for better risk-adjusted returns. Use stop losses carefully. In volatile microcaps, tight stops get triggered constantly. Wide stops provide no protection. Waite recommends thesis-based stops, not price-based
Your
stops.
investment thesis breaks, sell immediately. If the company loses a major customer, sell. If fraud is discovered, sell. Do not wait for price targets. Broken thesis means exit. However, if nothing fundamental changes and price drops, do not sell. Volatility is normal. Weak hands sell at bottoms. Strong hands use drops to add to positions. Size positions based on conviction and risk. High conviction, low risk ideas deserve larger positions. Low conviction, high risk ideas deserve smaller positions. Thoughtful sizing optimizes portfolio. Calculate position size using expected value. Multiply probability of success by potential gain. Subtract probability of failure times potential loss. Positive expected value justifies investment. For example, 60% chance of tripling investment equals 180% expected return. 40% chance of 50% loss equals negative 20%. Net expected value is 160%. This is attractive. Rebalance regularly. Winners grow into oversized positions. This concentrates risk. Trim winners, redeploy capital into new opportunities. Systematic rebalancing maintains risk discipline. But do not rebalance too frequently. Transaction costs matter. Taxes matter. Rebalance when positions exceed 20% of portfolio or when fundamentals change. Use trailing stops on huge winners. If stock is up 300%, protect gains. Trailing stop at 50% below peak locks in profits while allowing further upside. Understand correlation. Owning 10 oil companies is not diversification. They move together.
True diversification requires uncorrelated assets. Study correlations between positions. Waite emphasizes position sizing for black swan events. Allocate small amounts to ultra-high-risk, ultra-high-reward opportunities, options, biotechs awaiting FDA approval, exploration companies. Risk 1% to potentially make 50%. Losing 1% is acceptable. Making 50% is transformative. Multiple small lottery tickets occasionally hit jackpots. Set maximum loss per investment. Never risk more than you can afford to lose. If you cannot handle a complete loss, position is too large. Size positions to sleep well at night. Create portfolio rules. Write them down. Follow them strictly. Rules prevent emotional decisions. They enforce discipline. Winning investors follow systems religiously. Review portfolio monthly. Evaluate each position. Is thesis intact? Has risk increased? Should position size change? Regular reviews maintain portfolio health. Learn from sizing mistakes. Did you sell too early? Hold too long? Position too large? Analyze errors. Adjust rules. Continuous improvement in risk management is essential. Risk management seems boring. It is not glamorous, but it is what separates professionals from amateurs. Master risk management. It protects capital. Protected capital compounds into wealth. Chapter 8. Avoiding microcap scams and frauds. Microcap markets attract scammers. Lack of regulation and attention creates opportunities for fraud. Protect yourself by recognizing red flags. Justin Waite warns that pump and dump schemes are common. Promoters buy cheap shares. They hype the stock through newsletters, social media, and spam. Price rises, they sell. Price collapses, investors lose. Avoid any stock being heavily promoted. Legitimate companies do not need aggressive marketing. Real value attracts investors organically. Promotion indicates questionable fundamentals. Check who is paying for promotion. SEC requires disclosure. If a company pays for articles or emails promoting their stock, avoid it. Paid promotion is a massive red flag. Research the management team thoroughly. Google their names. Check backgrounds. Have they been involved in previous failures or frauds? Track records matter. Serial failures keep failing. Look for related party transactions. Are management selling property to the company? Are they using company money for personal expenses? Related party deals often benefit insiders at shareholder expense. Examine share structure. Excessive shares outstanding dilutes value. Constant stock issuance enriches management while destroying shareholder value. Companies should buy back shares, not issue them constantly. Be wary of reverse mergers. These create public companies quickly by merging with dormant shells. Some are legitimate, many are scams. Reverse merger companies deserve extra scrutiny. Check for continuous financing. Companies constantly raising money through private placements dilute shareholders. This enriches insiders through fees and cheap shares. Sustainable businesses do not constantly need financing. Waite emphasizes studying the footnotes in financial statements. This is where companies hide problems. Complex footnotes obscure reality. Simple footnotes suggest straightforward business. Look for multiple auditor changes. Switching auditors frequently indicates problems. Auditors resign when they discover issues. Multiple auditor changes are enormous red flags. Research the auditor. Unknown auditors lack scrutiny. They sometimes allow questionable accounting. Top companies use reputable auditors. Microcap scams use unknown auditors. Check legal proceedings. Read the 10K legal section. Companies sued frequently have problems. Class action lawsuits especially indicate serious issues. Be cautious with overseas companies. Some legitimate foreign companies list in U.S. markets, but many are frauds. Due diligence is harder with foreign companies. Accounting standards differ, cultural differences obscure truth. Avoid companies with no revenue. Pre-revenue companies are speculative. Most fail. Unless you're a venture capital expert, avoid pre-revenue investments. Established revenue provides safety. Question companies with no clear business model. If you cannot understand how they make money, avoid them. Complexity hides fraud. Simplicity reveals strength. Look for actual products and customers. Visit websites. Buy products if possible. Read customer reviews. Companies with real products are less likely to be frauds. Check insider ownership. Management should own significant stock, but be wary if one person owns 90%. Concentrated ownership enables manipulation. Waite recommends using SEC Edgar database. Read all filings. 8Ks announce material events. 10Qs are quarterly reports. 10Ks are annual reports. Proxy statements reveal executive compensation. Study everything. Join short seller research sites. Short sellers expose frauds. Hindenburg Research, Muddy Waters Research, and Citron Research publish devastating reports. If shorts target a company, read their reports carefully. They are often right. Trust your instincts. If something feels wrong, it probably is. Do not rationalize red flags. Do not convince yourself problems are not real. When in doubt, stay out. Understand that losing money to fraud is devastating psychologically. It is not just financial loss. It is betrayal. Avoid frauds completely. Conservative approach preserves capital and sanity. Not every struggling company is fraud. Some are simply bad investments. Learn to distinguish fraud from failure. Both lose money, but for different reasons. Your reputation matters. Recommending stocks that turn out to be frauds damages credibility. Be conservative with recommendations. Protect yourself and others. Scam avoidance is defensive. It does not make money directly, but it prevents losses. Prevention of losses is as valuable as generation of gains. Master fraud detection. Chapter 8. Building a microcap portfolio. Creating a winning portfolio requires strategy. Random collection of stocks does not work. Systematic construction optimizes risk and return. Justin Waite recommends starting with core positions. These are high-quality, lower-risk microcaps, established businesses with proven models, steady growth, strong balance sheets. Core positions provide stability. Allocate 50 to 60% of portfolio to core positions. These are foundation holdings. They will not multiply 10 times quickly, but they will not go to zero either. Add growth positions next. These are companies with high growth potential but more risk. Emerging businesses, new products, expanding markets. Growth positions provide upside. Allocate 30 to 40% to growth positions. These can double or triple, but some will fail. Diversification across multiple growth positions manages risk. Include some speculative positions. These are high-risk, high-reward opportunities. Early-stage companies,
Deep value
turnarounds.
situations. Speculative positions provide home run potential. Allocate 10 to 20% maximum to speculative positions. Most will fail, but one 10-bagger pays for 9 losers. Lottery ticket approach with small position sizes. Balance sectors carefully. Do not concentrate in one industry. Technology, healthcare, industrials, consumer, energy, materials, financials. Spread across sectors. Consider economic cycle positioning. Some sectors perform better in expansions, others in recessions. Balanced exposure reduces economic risk. Include both growth and value stocks. Growth stocks have momentum. Value stocks have safety. Combination provides balance. Pure growth or pure value strategies increase risk. Think about market cap diversification. Mix $50 million companies with $200 million companies.
Smaller ones have more upside. Larger ones have more stability. Waite emphasizes liquidity considerations. Some microcaps trade very low volume. Exiting positions is difficult. Mix liquid and illiquid positions. Never let illiquid positions exceed 20% of portfolio. Plan entry strategies. Do not buy everything at once. Dollar cost average into positions. Buy in thirds over weeks or months. This reduces timing risk. Set price targets at purchase. Determine exit price for both gains and losses. Write them down. Emotional discipline is easier with predetermined targets. Use limit orders, not market orders. Microcaps have wide bid-ask spreads. Market orders get poor execution. Limit orders control price. Monitor positions regularly, but not obsessively. Weekly reviews are sufficient. Daily monitoring creates emotional reactions. Longer time frames provide perspective. Keep detailed records. Track purchase prices, dates, thesis, and targets. Review past decisions. Learn from successes and failures. Documentation improves future decisions. Reinvest dividends automatically. Few microcaps pay dividends, but when they do, reinvest. Compounding requires reinvestment. Every dollar reinvested multiplies over time. Consider tax efficiency. Hold winners more than 1 year for long-term capital gains rates. Harvest losses strategically. Tax planning keeps more money working. Balance annually. Winners grow too large. Losers shrink. Rebalancing maintains risk profile. Sell high, buy low. Systematic rebalancing enforces discipline. Build cash reserves. Keep 10 to 20% in cash. Cash provides ammunition for opportunities. When markets crash, cash is valuable. Patient cash deployment maximizes returns. Avoid leverage in microcap investing. Margin amplifies gains, but also losses. Microcap volatility makes leverage dangerous. One bad move can wipe you out. Invest only what you own. Create investment policy statement. Define objectives, risk tolerance, strategy, and rules. Written policy prevents emotional decisions. It provides framework for consistent execution. Start small. Do not invest entire portfolio immediately. Begin with 10 to 20%. Learn, gain experience. Increase allocation as skills improve. Track performance honestly. Calculate returns properly. Include all fees and taxes. Compare to benchmarks. Honest assessment reveals strengths and weaknesses. Waite reminds that portfolio construction is dynamic. Markets change. Opportunities shift. Adjust portfolio as conditions evolve. Flexibility within framework is essential. Building a portfolio takes time. Rome was not built in a day, neither are fortunes. Patience, discipline, and consistency create wealth. Start today. Build systematically. Trust the process. Chapter 9. Timing your microcap investments. Timing is not everything, but it matters. Buying quality companies at wrong times reduces returns. Strategic timing enhances results significantly. Justin Waite teaches that market cycles are real. Bull markets and bear markets alternate. Understanding cycles improves timing. Never fight the trend. In bull markets, valuations expand. Investors are optimistic. Even mediocre companies rise. This is time to be selective. Avoid chasing momentum. Focus on quality. In bear markets, valuations contract. Fear dominates. Quality companies get cheap. This is time to be aggressive. Buy fear. This creates best returns. Learn to recognize market tops. Extreme optimism. Everyone is bullish. Valuations are stretched. IPO activity surges. These signal danger. Reduce exposure. Recognize market bottoms. Extreme pessimism. Everyone is bearish. Valuations are depressed. Bankruptcy fears abound. This signal opportunity. Increase exposure. Sector rotation is important. Different sectors lead at different times. Technology leads early in bull markets. Industrials and materials lead mid-cycle. Defensives lead late cycle. Understand economic indicators. GDP growth, unemployment, interest rates, inflation. These affect stock performance. Rising rates hurt growth stocks. Falling rates help them. Watch the yield curve. Inverted yield curve predicts recessions. Normal curve predicts growth. Steep curve predicts strong growth. Yield curve provides economic signals. Monitor Fed policy. Interest rate decisions impact markets massively. Rate cuts stimulate economies. Rate hikes slow them. Fed watching is essential. Waite recommends technical analysis for timing. Chart patterns reveal sentiment. Support and resistance levels matter. Moving averages show trends. The 200-day moving average is key. Stocks above it are in uptrends. Below it are in downtrends. This simple indicator improves timing. Relative strength shows momentum. Stocks outperforming the market have momentum. Underperforming stocks lack it. Buy strength. Avoid weakness in bull markets. Volume confirms price moves. Rising prices on high volume are sustainable. Rising prices on low volume are suspicious. Volume provides conviction. Accumulation and distribution patterns matter. Accumulation is buying by informed investors. Distribution is selling. These patterns predict future moves. Seasonality affects returns. Sell in May and go away has merit. November through April outperforms May through October historically. Consider seasonal patterns. Tax loss selling in December creates opportunities. Investors sell losers for tax purposes. Quality companies drop artificially. January often recovers these names. Year-end is good buying time. Earnings announcements create volatility. Avoid buying right before earnings. Wait for results. Information reduces risk. Patience prevents mistakes. Product launch timing matters. Buy before anticipated approvals or releases. Sell the news. Buy the rumor, sell the news works in microcaps. Watch insider transactions. Insider buying before announcements indicates confidence. Insiders know upcoming news. Follow their lead. Insider selling sometimes precedes problems. Monitor short interest changes. Rising short interest indicates growing pessimism. This can signal problems or create squeeze potential. Analyze why shorts are increasing. Falling short interest suggests shorts are covering. This can precede rallies. Short covering creates buying pressure. Use short interests strategically. Waite emphasizes patience in timing. Do not force trades. Wait for optimal setups. Cash is a position. Waiting for the right moment beats rushing into wrong ones. Use staged entries. Do not buy full position immediately. Buy 1/3 now, 1/3 on dip, 1/3 on confirmation. Staged entry reduces timing risk. Similarly, use staged exits. Sell 1/3 at first target, 1/3 at second target,
Hold
1/3 at
1/3 for home run. Staged exits capture gains while maintaining upside. Avoid panic selling. When everyone is selling, resist. Forced selling creates opportunities. Be greedy when others are fearful. This is when fortunes are made. Avoid FOMO buying. When everyone is buying, be cautious. Euphoria precedes tops. Missing rallies is better than buying peaks. Patience prevents costly mistakes. Study historical patterns. Market behavior repeats because human psychology is constant. Past patterns guide future decisions. History does not repeat exactly, but it rhymes. Create watch lists during bear markets. Identify quality companies. Set target prices. Wait patiently. When prices reach targets, execute. Preparation enables action. Market timing is controversial. Some say it is impossible. Others say it is essential. Truth is somewhere between. Perfect timing is impossible. Reasonable timing is achievable. Combine timing with fundamentals. Do not buy bad companies because timing looks good. Do not avoid great companies because timing seems poor. Balance both considerations. Accept that timing will not be perfect. Bottoms are only clear in hindsight. Tops are only obvious later. Approximate timing is sufficient. Do not demand perfection. Track your timing decisions. Record why you bought when you did. Review later. Learn from timing successes and failures. Improvement comes through analysis. Remember that time in market beats timing the market over long periods. Consistent investment compounds wealth. Market timing attempts often underperform. Balance active timing with long-term holding. Timing is a skill. It improves with experience. Study markets. Observe patterns. Practice patience. Over years, timing intuition develops. Trust the learning process. Chapter 10. Exit Strategies for Maximum Profits. Knowing when to sell is harder than knowing when to buy. Poor exit strategies destroy returns. Strategic selling locks in gains and minimizes losses. Justin Waite teaches that having exit plan before buying is essential. Emotion-free selling requires predetermined rules. Write down exit criteria at purchase. Set price targets based on valuation. If you buy at $5 expecting fair value of $15, sell at $15. Do not get greedy hoping for 20. Time-based exits work for some strategies. If you plan to hold 3 years, sell after 3 years regardless of price. This forces discipline and portfolio rotation. Use trailing stops on big winners. If stock is up 200%, set trailing stop at 25% below peak. This locks in 150% gain while allowing further upside. Trailing stops should widen over time. Do not use 10% trailing stops on volatile microcaps. 25 to 40% is reasonable. Prevents getting stopped out prematurely. Sell when thesis breaks. If you bought for new product launch and launch fails, sell immediately. Broken thesis means exit. Do not rationalize holding. Management changes often warrant selling. New CEO brings uncertainty. Unless new management is upgrade, selling is prudent. Leadership matters enormously. Deteriorating fundamentals demand action. Declining margins, slowing revenue growth, rising debt. These signal problems. Exit before situation worsens. Sell when valuation becomes extreme. If your microcap reaches large cap valuations, upside is limited. Take profits. Redeploy into better opportunities. Waite recommends scaling out of positions. Sell 25% at first target. 25% at second target, 25% at third target. Hold final 25% for potential home run. Scaling out captures gains progressively. It also maintains exposure for unexpected upside. Psychological benefit is huge. You have both cash and position. Consider tax implications when selling. Holding 1 year versus 11 months dramatically affects taxes. Sometimes waiting few weeks saves thousands. Plan sales tax efficiently. Rebalance into new opportunities. Selling winners funds new positions. Portfolio becomes stale without rotation. Fresh capital in new ideas maintains growth. Sometimes best exit is no exit. If fundamentals keep improving and valuation remains reasonable, hold indefinitely. Best stocks are often under-owned because sold too early. Amazon, Netflix, Monster Beverage rewarded long-term holders with life-changing returns. Selling at double or triple missed 10-baggers or 100-baggers. Balance taking profits with holding great companies. Avoid round number psychology. Do not wait for a stock to hit exactly $10. If it hits $9.50 and shows weakness, sell. Arbitrary round numbers do not matter. Track distribution patterns. Heavy volume selling by insiders or institutions indicates smart money exiting. When big players sell, consider following. Acquisition offers are clear exit points. If a company receives buyout offer, sell into the offer. Takeovers usually represent full value. Do not hold hoping for higher bid. However, analyze whether the offer price is fair. Sometimes offers are lowball. If board rejects and stock drops, that creates buying opportunity for patient investors. Bankruptcy risk requires immediate exit. If a company is filing bankruptcy, equity often goes to zero. Bondholders get paid first. Equity holders get nothing. Do not hold hoping for a miracle. Market crashes create difficult decisions. Selling in panic locks in losses. But holding through disaster is painful. Set maximum drawdown tolerance. If position drops 50%, that is a reasonable exit rule. Distinguish between stock price drops and business deterioration. Price drops without business problems are buying opportunities. Business deterioration causing price drops requires
Waite emphasizes emotional discipline in selling. Humans hate realizing losses. We hold losers, hoping for recovery. We sell winners too early, fearing giving back gains. Both mistakes are emotional. Create selling rules. Follow them mechanically. Remove emotion. Systematic selling improves results dramatically. Track selling decisions. Record why you sold. Review later. Did you sell too early? Too late? Analysis improves future selling. Consider opportunity cost when holding. Is your money better deployed elsewhere? Holding mediocre performers costs potential gains from better opportunities. Accept that perfect exits are impossible. You will never sell at exact tops. Leaving money on table is fine. Greed is expensive. Reasonable profits beat waiting for perfect profits. Celebrate wins appropriately. When you make good money on investment, acknowledge success. Positive reinforcement encourages good behavior, but do not get overconfident. Learn from losses equally. Every losing trade teaches lessons. Extract wisdom. Apply to future decisions. Losses are tuition for investor education. Remember that selling is not failure. It is portfolio management. Dynamic allocation optimizes returns. Static portfolios underperform. Strategic selling is essential skill. Exit strategies separate professionals from amateurs.
Master the art of selling. It protects capital. It locks in gains. It enables compounding. Selling well is as important as buying well. Chapter 11. Advanced Microcap Strategies. Once you master basics, advanced strategies enhance returns. These techniques require experience, but they provide additional edges in microcap investing. Justin Waite discusses special situations investing, spin-offs, bankruptcies, liquidations, mergers. These events create inefficiencies. Sophisticated investors exploit them profitably. Spin-offs often outperform. Parent companies divest unwanted divisions. The new entities trade independently. Initially, they are ignored. Research reveals hidden value. Invest in spin-offs immediately after separation. First few months see selling pressure from index funds and parent company shareholders. This creates opportunity. Quality spin-offs recover quickly. Bankruptcy investing is high-risk, high-reward. Companies emerge from bankruptcy with cleaned balance sheets. Debt is eliminated. Operations are streamlined. If business model works, returns are spectacular. Research bankruptcy plan carefully. Understand what equity holders receive. Sometimes equity is canceled. Sometimes equity participates in recovery. Know your position in the capital structure. Liquidation investments involve companies selling all assets. If stock trades below liquidation value, downside is protected. Patient investors earn returns as assets are sold and distributed. Calculate liquidation value conservatively. Assume distressed sale prices. Real estate at 70 cents on the dollar. Inventory at 50 cents on the dollar. Equipment at 30 cents on the dollar. Conservative estimates prevent disappointment. Merger arbitrage exploits price differences between announced deal price and current stock price. If company announces acquisition at $10 and stock trades at $9, $1 spread is potential profit. Risk is deal not closing. Regulatory rejection, financing failure, material adverse change. These cancel deals. Spread compensates for this risk. Analyze deal completion probability. Activist investing involves buying stakes and pushing for changes. Replace management. Sell assets. Return cash to shareholders. Activism unlocks value in mismanaged companies. Small investors can piggyback activist campaigns. Follow activist investors into positions. They do the heavy lifting, you benefit from the changes they implement. Waite teaches sum of parts arbitrage. Companies with multiple divisions sometimes trade below the value of individual parts. Buying the stock and hoping for separation captures value. Identify companies where divisions could be separated. Calculate value of each piece independently. Compare to market cap. Large discounts indicate opportunity. Event-driven investing focuses on catalysts, FDA approvals, patent awards, contract announcements, earnings surprises. Events change valuation suddenly. Anticipating events creates profits. Study upcoming events. Assess probabilities. Calculate risk-reward. Position before events. Capture value when events materialize positively. Pair trading involves long position in undervalued company and short position in overvalued competitor. If thesis is correct, you profit regardless of market direction. This strategy requires margin and short selling capability. Risk is both positions moving against you, but correlation between competitors often makes this strategy effective. Options provide leverage. Call options magnify gains with limited risk. Put options provide downside protection or bearish exposure. Options are complex but powerful tools. Study options thoroughly before using them. Time decay, implied volatility, strike selection matter enormously. Options are not for beginners, but experienced investors use them effectively. Warrants are common in microcaps. They are long-term call options issued by the company. Warrants provide leverage with less time decay than regular options.
Analyze warrant terms carefully. Exercise price, expiration date, dilution impact. Sometimes warrants are a cheaper way to gain exposure than buying stock directly. Convertible bonds offer downside protection with upside participation. If stock drops, bond provides floor. If stock rises, conversion to equity captures gains. Microcap convertible bonds are rare but valuable when available. They combine safety of debt with growth potential of equity. Rights offerings give existing shareholders opportunity to buy additional shares. Sometimes rights are undervalued. Buying rights provides cheap exposure. Study rights terms, understand dilution, calculate value. Rights offerings sometimes create temporary selling pressure that creates opportunity. Waite emphasizes that advanced strategies require experience. Do not attempt them as beginner. Master fundamentals first. Advanced strategies amplify skills, but also amplify mistakes. Paper trade advanced strategies first. Test without real money. Learn mechanics. Understand risks. Only use real money after demonstrating paper trading success. Limit advanced strategies to small portfolio percentage. These are enhancement, not core strategy. Core should always be fundamental microcap investing. Continue education constantly. Read books on special situations. Study case studies. Learn from experts. Advanced strategies are constantly evolving. Network with sophisticated investors. Discussion improves understanding. Others share insights you lack. Community accelerates learning. Remember that complexity does not guarantee returns. Simple strategies often outperform complex ones. Do not use advanced strategies just because you can. Use them when they provide clear advantage. Advanced strategies are tools in the toolbox. Use appropriate tool for specific situation. Sometimes simple buy and hold is best. Sometimes complex strategy is optimal. Judgment determines which tool to use when. Chapter 12. Psychology of Microcap Investing. Investment success is 80% psychology, 20% knowledge. Mastering your mind is more important than mastering markets. Justin Waite explains that fear and greed dominate investor behavior. Fear causes selling at bottoms. Greed causes buying at tops. Both destroy returns. Fear manifests in many ways. Fear of losing money prevents buying bargains. Fear of missing out causes chasing momentum. Fear of being wrong prevents admitting mistakes. Recognize fear when it arises. Acknowledge it. Do not deny it. Then act rationally despite fear. Courage is not absence of fear. It is action despite fear. Greed is equally destructive. Greed causes holding too long, taking excessive risk, buying on leverage. Greed turns winners into losers. Practice gratitude for gains. Appreciate profits. This reduces greed. Contentment enables rational decisions. Greed is never satisfied. It always wants more. Confirmation bias is dangerous. We seek information supporting our views. We ignore contradicting evidence. This blinds us to reality. Actively seek disconfirming evidence. Read bear cases.
Consider opposite perspectives. Devil's advocate thinking prevents costly mistakes. Anchoring causes us to fixate on irrelevant numbers. Purchase price becomes anchor. We refuse to sell below it. But markets do not care what you paid. Make decisions based on current information, not past prices. Sunk costs are sunk. Only future potential matters. Break free from anchors. Recency bias causes us to overweight recent events. Recent gains make us overconfident. Recent losses make us overly cautious. Both are errors. Review long-term data. Do not overreact to recent volatility. Long-term perspective prevents emotional reactions to short-term noise. Herd mentality is powerful. Humans are social. We follow crowds. But crowds are often wrong at extremes. Cultivate independent thinking. When everyone agrees, be skeptical. Consensus is often wrong at turning points. Contrarian thinking generates alpha. Overconfidence follows success. Early wins create a false sense of mastery. Markets humble overconfident investors eventually. Stay humble always. Respect markets. Acknowledge uncertainty. Humility prevents catastrophic mistakes. Arrogance invites disaster. Waite teaches that patience is the ultimate psychological weapon. Impatient investors lose money. Patient investors accumulate wealth. Practice patience deliberately. Wait for perfect pitches. Do not swing at bad opportunities. In investing, you do not have to swing. Patience is rewarded. Develop emotional awareness. Notice your emotions. Are you excited, anxious, fearful, euphoric? Emotions signal psychological state. When emotions are extreme, wait. Extreme emotions cloud judgment. Calm decisions are better decisions. Build emotional
Create
intelligence.
psychological distance from money. Do not check portfolio constantly. Frequent checking increases anxiety. It encourages poor decisions. Set checking schedule, once weekly or monthly. Less frequent monitoring reduces emotional reactions. It improves long-term focus. Maintain life balance. Investing is important, but not everything. Strong relationships, health, hobbies matter more. Balanced life creates stable psychology. Exercise regularly. Physical health affects mental health. Exercise reduces stress. It improves clarity. Healthy body supports healthy mind. Sleep adequately. Tired brains make poor decisions. 7 to 8 hours minimum. Sleep deprivation is cognitive impairment. Prioritize rest. Meditate or practice mindfulness. These techniques calm mind. They increase awareness. They improve emotional regulation. Even 10 minutes daily helps. Journal your thoughts and decisions. Writing clarifies thinking. It reveals patterns. It documents lessons. Journaling accelerates psychological growth. Learn from mistakes without self-criticism. Mistakes are data. They teach lessons. Harsh self-judgment prevents learning. Self-compassion enables growth. Celebrate wins without arrogance. Acknowledge success. Feel proud. But remember that luck plays role. Gratitude and humility coexist with celebration. Build support network. Discuss challenges with trusted friends. Isolation amplifies problems. Community provides perspective. Shared struggles feel lighter. Waite reminds that every great investor has lost money. Warren Buffett, George Soros,
Peter Lynch. Losses are inevitable. How you handle them determines long-term success. Accept losses as business expenses. They are cost of doing business. Do not take them personally. Analyze, learn, move forward. Remember your why. Why are you investing? Financial freedom? Family security? Early retirement? Clear purpose sustains motivation through difficulties. Visualize long-term success. See yourself achieving goals. Visualization programs subconscious mind. It maintains focus during challenging periods. Trust the process. Good strategy with discipline produces results over time. Doubt creates inconsistency. Inconsistency destroys returns. Maintain faith in proven approach. Psychology is your competitive advantage. Most investors have similar information. Different psychology produces different results. Master your mind. Master markets. You now possess the knowledge to become a microcap millionaire. Justin Waite's strategies are proven. They work. But knowledge without action produces nothing. Start immediately. Open brokerage account today. Begin building watch list this week. Make your first investment this month. Action creates results. Delay creates regret. Remember that wealth building takes time. Microcap investing is not get-rich-quick scheme. It is a systematic approach requiring years. Patience and discipline compound into millions. Focus on the process, not outcomes. Control what you can control. Research, analysis, position sizing, risk management. These are controllable. Stock prices are not. Trust your process. Continue learning constantly. Markets evolve. Strategies adapt. Successful investors never stop learning. Read books. Take courses. Study companies. Education is lifelong. Network with other microcap investors. Join forums. Attend conferences. Build relationships. Community accelerates learning. Shared knowledge benefits everyone. Stay humble before markets. Overconfidence destroys. Respect risk always. Preserve capital above all else. Survival enables compounding. Celebrate small wins. Every successful investment teaches lessons. Every good decision builds confidence. Acknowledge progress. Positive momentum accelerates growth. Learn from losses equally. Every mistake provides education. Extract lessons. Apply them forward. Losses are expensive teachers, but valuable ones. Balance investing with life. Money is a tool, not a goal. Build wealth to create freedom. Freedom to spend time with family. Pursue passions. Make impact. Think long-term constantly. Daily fluctuations are noise. Quarterly results are data points. Multi-year trends create wealth. Extend your time horizon. Give back as you prosper. Help others learn. Share knowledge generously. Mentor new investors. Contribution creates meaning beyond money. Remember Justin Waite's core message. Microcap stocks offer life-changing opportunities. They require work, discipline, and courage, but rewards justify efforts. Ordinary people become millionaires through microcap investing. You can too. Start where you are. Use what you have. Do what you can. Your journey begins today, not tomorrow, not next week, right now. Take one action. Open account. Research one company. Read one financial statement. Small actions compound into extraordinary results. Every expert was once beginner. Every millionaire took first step. Your first step is now. The wealth you seek is within reach. Microcap stocks are your vehicle. Knowledge is your map. Discipline is your fuel. Persistence is your engine. Drive forward with confidence. You have the tools. You have the knowledge. You have the potential. Success requires only commitment and action. Apply these principles. Transform your financial future. Become the microcap millionaire you are capable of becoming. Your richest life awaits. Start building it today.